Ladies and gentlemen, dear colleagues, my name is Helmut Heiss from the University of Zurich in Switzerland, and I have the pleasure today to welcome you wholeheartedly to our transatlantic lectures on international law. This new lecture series is based on a new initiative, which in turn is based on a very simple idea that the organizers have thought that it would be fruitful to discuss issues of insurance and reinsurance law on a transnational level. And that would be fruitful to either participant. To take such an initiative, you need, first of all, to find top experts being ready to participate in such a conference and give speeches on relevant topics. And we are very glad having found top experts for our first and inaugural lecture today. Secondly, and equally important, you must find participants. Participants, if you call it a transatlantic lecture, from both sides of the Atlantic and also from both hemispheres of this world. And we are happy to welcome today participants from South Africa, from various countries in South America, from North America, USA, Canada, as well as from various countries in Europe. And that makes us very happy because it shows that our initiative has been welcomed. Now, what is our initiative? It is the initiative of a so-called insurance law special interest group that is organized within the framework of the European Law Institute in Vienna. The European Law Institute considers itself to be a European counterpart to the American Law Institute, and that also gave sort of hand to the idea of building a bridge across the Atlantic between the west and the east side of the Atlantic. Now, more personalized, the organizers of this lecture series are Christoph Brömmelmeier from Frankfurt Oder in Germany, Eric Knudsen from Queen's University in Canada, Jeff Stample from University of Nevada, Las Vegas, USA, Oliver William from University of Bern in Switzerland, and myself from the University of Zurich in Switzerland. And that also shows that we try to bridge also on the organizatoric level of our lectures. Now, this is it from my side. I'm very happy that we can start with the lectures, and I will pass on the word now to my colleague, Jeff Stample, who will introduce our first speaker. Jeff, please. You have to unmute, Jeff, please.
A little bit. I'm the real Jeff Stemple. The other is merely an imposter, but I'm sure Eric will have that problem fixed soon. It's my pleasure to introduce our first speaker today, Tom Baker, who for certainly an American and probably an international audience needs no real introduction. He's the William Mulnezy Professor at the University of Pennsylvania Law School. Has been in teaching for 30 years since his graduation from Harvard Law School at the Universities of Miami, Connecticut, and now Penn, author of dozens of law review articles, half a dozen really outstanding books, and one that many of us think will become highly authoritative. He is with a co-reporter of the American Law Institute's Restatement of the Law of Liability and Insurance, and after that exhausting task, one would have thought Tom would rest on his laurels, but instead he established the COVID coverage litigation tracker, which interested folks can find at cclt.law.upenn.edu, an invaluable tool for folks trying to follow this morass of litigation that we've had in the last year. Tom will be addressing those issues in terms of COVID litigation in the United States. And now, without further ado, Tom Baker.
Thank you very much. I'm going to share my screen. I have some slides that I hope will be useful for people to see, and I just have to do a little tech support here. I feel that in this day of COVID teaching that we all ought to have producers that live at our houses and take care of all these problems for us. So I'm going to talk about the US perspective, and it's very much, a perspective from, let's call it the rowdy, disorganized side of the Atlantic. You know, the UK had its very nice system that got us a quick answer with the things. I understand from looking at the chat that the Austria Supreme Court has already answered the question, and we'll hear about it, what else is happening in Europe. But in the US, it's very much still an open, messy question. So what I'm gonna do today is I'm gonna talk about the USBI litigation. I'm gonna tell you about the COVID coverage litigation tracker project, which is a project that I think will be interesting to people beyond this particular application. We'll talk about the key legal issues and the early results, and then a little bit about what this teaches us from a public policy perspective. This is a screenshot from the COVID coverage litigation tracker, which shows the weekly filings of cases that arise out of the COVID pandemic. And, you know, as you can get the picture, that huge in the beginning has tailed off towards the end. This chart is a few weeks old, but it basically has continued at the same low level since then. There was a blip. Last week was a big week because certain insurance policies have a 1-year suit requirement deadline that the carriers did not on the whole extend. So there was a variety of lawsuits last week. So we'll get a bump in the next picture, but this is just a picture of showing from the overall. There are, as this reflects, and again, this is a little bit older, but there are over 1,600 cases in our database, which includes, it's a comprehensive database of cases in the federal, or what people think of as the US courts. It is not comprehensive of cases that are in the state courts, because the federal courts have a unified electronic docket system that various services allow you to access very easily. And there's a new service called Lex Machina that I highly recommend if you want to do this kind of research, that allows you to do text-based searches and complaints to find cases. But for states, it's the Wild West. And so we think that there's another 700 cases that we don't know about, and we have a very crude estimate for that. As this slide selects, most of the cases are business income cases. There's some, you know, and in part this is because, you know, what was the response of the carriers to the pandemic? The response for business income claims was a blanket denial of coverage by all carriers of all claims. For event cancellation policies, my sense is that the carriers mostly paid, and that's reflected. You can see there's a smaller number of event cancellation policy claims. There were some specialized contamination policies sold, and sometimes some contamination coverage on an endorsement, and some litigation around that less. A little set of cases that are seeking premium relief, saying essentially to auto insurers and homeowners insurers, hey, because of the pandemic, you haven't paid out all the claims that you thought you would, so give us some of our money back. Those haven't been successful. In my sense, they're not going to be successful. Liability insurance claims related to the COVID are just at the early stages, and you know that's to be expected because the law in the U.S., as reflected in the restatement of the law of liability insurance, is extremely harsh on carriers that don't defend cases. So that on the whole, I think carriers are defending claims under reservation of rights to the extent there are COVID-related claims, and there'll be litigation over whether they're covered later. This is a little picture. So of the 1,600 cases in the database, this is a picture of how they have left, or what my colleague, I'm doing some empirical, we're going to be doing some sort of quantitative analysis of this. I'm working jointly with Michael Heiss from Cornell Law School and my colleague John Click at Penn. And so Michael talks about the concept of melt of cases. And so this shows you the melt. 211 cases have been voluntarily dismissed. That these cases tend to be dismissed after the insurer has filed a motion to dismiss and before the policyholder deadline to respond, and basically the sense is that these are cases in which the policyholder either has decided it's not worth spending the money to litigate, or they want to preserve the option to keep their claim, but wait and let other people pay to develop the law. some cases dismissed by court order without prejudice. What does that mean? This was a case that there's a procedural mechanism in the US called a motion to dismiss. For a motion to dismiss, the court accepts all the facts pleaded in the document called the complaint as true, and the court decides whether, if all those things are true, has the policyholder or the plaintiff stated a claim for which there is legal recourse. Courts have two choices. They can dismiss a claim without prejudice, which means the policyholder has the opportunity to file an amended complaint and try again, or voluntarily dismiss the case. And then, as long as there's within the statute of limitations, or if the suit requirement deadline applies, there's a deadline on when they can refile it, or they can file an amended complaint and try again. When a case is dismissed by court order with prejudice, that's over. That's a victory at the trial level by the party that wins that, and that it will be the defendant, which in these cases is almost universally the insurance company. And at that point, the policyholder can either go away or appeal, and there are 60 odd appeals pending in the United States right now. And as I'll talk about in a minute, there is almost no, well, there's been no decisions of an appellate court on the COVID cases, and none, zero, not in any state, not in any federal court. And there are remarkably few really analogous cases in the appellate courts of either the states or the federal courts. And so we're along on the rowdy Wild West side of the Atlantic. We're a long way from being done. All right, so that's just a picture of the litigation.
Please forgive me for interrupting you, but can I mention that we still see the cumulative filings slide? We didn't see
you didn't see it?
We didn't see the melting slide.
Oh, you didn't see the melting. Did you see this one, the insurance termination summary?
Yes,
do you see,
we see that now?
Yeah.
Yes.
Yeah. Okay. I'm
Thank
sorry.
You.
Yeah.
Sorry for interrupting.
No worries. So let me just leave that up while I talk about the COVID coverage litigation tracker is a project that's designed to, as really with several purposes. One is to serve as a proof of concept for, can you create a database that follows real time and emerging a congregation of cases, and I would call that this sort of meta research question. And then secondarily, but it's blown up on the web and so forth, is to be a trusted source of information about these cases. And we are achieving that. And then, so what are some things that we're studying aside from just like keeping track of this? And we're identifying, comparing different methods that courts are using to manage case congregations. My colleague, Michael Heiss, informed me of something that, when you think about it, makes total sense, but I never thought about it before, was that when you have one of these emerging sets of cases, they're Bayesian in behavior, in the sense that a complaint that was filed in March is not the same as a complaint that's filed today, because people have learned sort of what works, what doesn't work. And we're trying to figure out if we can identify what those sort of key Bayesian updating events are and sort of tell a story about it. That, I would say at the moment, we haven't done, we've failed in identifying them in real time, but I think we'll be able to find them retroactively. And then we just, this is a new way, at least for us, I think generally, of sort of thinking about a case congregation in a quantitative way that gives you a sense of it kind of over time. And then, I'll talk about the fun. All right, so what are we collecting in the data? So we're collecting data that anyone could get, the basic docket information, the court, the docket number, the judges, the law firms, the key events. We're collecting and putting in the database documents from the case, and so these are PDFs mostly, and we're not collecting all of them. We're collecting selected ones, and then what are we doing? What is our contribution? Our contribution is that we've getting all this material from multiple sources, identifying what's important, following cases across courts and electronic services, and then coding them uniformly, independent of the original data source. And then what we've found, we've a development that I didn't, well, I guess I sort of anticipated, but it's been very important, is that we're getting now kind of real-time crowdsourcing. So as the COVID coverage litigation tracker has come to be the scorecard for what's happening, I get emailed from lawyers, 2 or 3 copies of any order, within, certainly within a day of when it comes out, because everyone wants their, their wins to be up on the scorecard. And then, what are we doing? It's mostly hand coded. I mean, I see something about data is the less people have worked with it, the more they believe it and the easier they think it is to collect it. So we have a team of students under my supervision, and I do some of it myself, of the hand coding a variety of information that people can look at on the slide afterwards if they want. So the key legal issues in the case, which this audience is probably already aware of, but let me just spell it out. So the threshold question, the gating question for all of the business interruption cases in the US is physical loss ever damage to, is there physical loss ever damage to property caused by or resulting from risks of direct physical loss? And that is maybe, I think perhaps surprising to European eyes, a remarkably open question under US law. The early results that I'll show you shortly are strongly in the favor of the answer to that question being no, but all those results are at the trial court level, mostly by federal courts. And one thing that people may not be aware of is that despite the fact that federal courts are more prestigious places to work in, they do not make insurance law. Insurance law in the United States is, for this purpose, 100% state law. So, there's 60 trial court decisions in California right now, most of which from federal courts, most of which say the answer to this question is no. But the minute that one intermediate appellate court in the state system in California decides the question, those 60 decisions will be completely irrelevant. And that hasn't happened yet. So there's the threshold question. Then the next question is, do exclusions apply? And the various exclusions, there's a smorgasbord of exclusions that the carriers have asserted, but the ones that really matter are a variety of virus exclusions. And then there's some very important procedural issues that are especially important given the fact that we have 50 state jurisdictions that are not all going to decide these former 2 questions equally. So there's basically 3 positions so far in the decisions on whether these COVID can be physical loss of or damage to property. There's the judge in the Society Mutual Insurance multi-district litigation, which is a interesting aggregate litigation procedure in the US that really should be the topic of its own session of this program, has decided that the answer is yes, that loss of use because of government orders designed to reduce the spread of virus is physical loss of property. There is, and this Judge Chang, has been followed very recently by Judge Kennelly, and there's a court in North Carolina that actually before Judge Chang decided this on a motion for summary judgment that declared that the carrier was liable. A second approach is that this idea that reduced use of property to prevent the spread of viruses on surfaces and through ventilation systems, that's physical loss of or damage to property. And there's a number of cases that have decided that. Studio 417 was perhaps the most significant early one, and that's in the Western District of Missouri Federal Court. And then the prevailing, I would say, the majority rule at this point is, at least the majority rule in federal courts, says that physical loss of or damage to property requires structural alternation of the property, not the presence of an easily cleaned substance. And that's a leading case saying that is the Terry's Barbecue case in federal court in Texas. There's an interesting question not yet answered: is do structural mitigation measures account? And there's a complaint in a case brought by Jenner and Block called Let Us Entertain You that raises that. On exclusions, 80% of the policies in the US were sold with some form of virus exclusion. There are explicit ones. The ISO has one that so far has held up 100%. The Hartford has one that I think is a little more vulnerable, but so far has held up pretty much. there's the microbe or microorganism exclusions that show up in, for example, the London policy. Some do list virus, some don't list virus. There are contamination exclusions. FM Global is a good example of that identifies virus as a contaminant. And I would say that is a multi-billion-dollar question for FM Global. And then there are some pollution exclusions that either do or don't identify virus as a pollutant that the carriers have relied on. And my opinion about these is that the ones at the top are going to stick, the ones at the bottom are not going to stick, and the ones in the middle, I don't know. Here's a picture taken from the COVID coverage litigation tracker that is quite stark. Blue and orange are policyholder victories at the motion to dismiss stage, which means the case survives to fight another day. Green are carrier full dismissals with kept prejudice, the case is over. On the left, federal courts, on the right, state courts. Huge difference in what the courts are doing. Some people say that's because it's easier to survive a motion to dismiss in state court, not in federal court. Therefore, this doesn't represent a real difference of opinion. I think there's something to that, but I think that the state courts are expressing a different view. And so I still wouldn't bet a lot of money on the insurance companies having to pay a whole lot of money, but I would bet more money than I would otherwise because of the state court. I think state courts in the US are very independent. They don't like to be told by the federal courts how state law is decided. So I think if you're looking at a simple count and hearing about it and thinking the carriers are trouncing the policyholders, I think it's too early to reach that conclusion. Here's a different picture. So this is shows whether we track whether things have a virus exclusion or not. Because if there's a virus exclusion, it affects even how you plead the physical loss or damage aspect of the coverage. You don't want to, if you have a virus exclusion, you don't want to say that your building was contaminated with the virus and it was spewing out of the ventilation, and the minute you cleaned it, it would be on the property again. So therefore, the presence of a virus exclusion means you're more likely to lose even on the physical loss or damage because you're not going to plead in the way that will be successful. And so, what this shows is that carriers are, winning both with and without virus exclusions in the federal courts, more significantly and overwhelmingly, would say 21-1 when there is a virus exclusion. Whereas it's pretty, carriers are winning in the state courts when there is a virus exclusion, but not overwhelmingly, and they are losing in state courts when there is not a virus exclusion. And this is now again, 80% of the policies in the U.S. have some sort of virus exclusion. So this is not going to be death for the insurance industry if they lose, but it isn't going to be a complete victory of the sort they're telling their shareholders at this time. All right, there's big procedural issues. This is litigation. So early on, there was an effort to have a mega multi-district litigation proceeding that would be in one court for the entire country. That failed. That is, by the way, one reason why there was so many cases filed early, because one way for lawyers to compete to be in charge of that is to have lots of cases. So a lot of lawyers who really hadn't ever done insurance cases before, but were really good at MDLs, either with or without teaming up with someone who was an insurance specialist, filed a lot of cases early on. That was unsuccessful. There have been some more limited MDLs. There are a lot of class actions proceeding, but they're proceeding without the court agreeing that they're certifying them as a class. And Jeff, I'd be curious what Jeff Stemple thinks about this, since he knows a lot more about this topic than I do. But I don't really, traditionally insurance coverage disputes haven't been certified as classes, so we'll see if this happens. But there are state MDLs, and so the ability of consolidating is very important. I get a kick, kind of an ironic kick out of what's happened with the litigation, because the insurance companies argued against the mega MDL on the grounds that all these policies are so different. But when they are arguing on the motion to dismiss, they're saying essentially, hey, all these federal courts are deciding that it should be dismissed. Yeah, there's not really big differences between the policies. So it's a bit of a, whatever. So given that we have 50 states, each is a sovereign for insurance law purposes, the choice of where to sue and what law will apply is going to be increasingly important, especially as we start to get some answers from the appellate courts about what the law is that applies. Let me just wrap up with just public policy implications that are probably obvious to this audience, but that, anyone who thinks that the private market is going to be stepping up to take care of this issue of business income against pandemic losses, is getting, the insurance market is telling us a profound no. I think, and this is just Tom Baker, I think we need another government backstop. If I were in charge of the universe, I would make that be a reinsurance program that was plugged through the private insurance market, because insurance companies are very good at evaluating and paying claims that they agree are covered. And that's going to be a much better targeting of relief money, in my opinion, than the kinds of government relief programs that we've had, at least in the US. I think, whatever, if Tom Baker was czar of the universe, I would have done even the bailouts. I mean, I would have done the payments that the US government did this time. I would have done them through retroactive reinsurance to funnel them through insurance companies, because again, they know how to evaluate and pay claims that they agree are covered. I mean, so many organizations that didn't really need the money got the money because of the way the government program was structured, and with the result that there wasn't very well targeted. Personally, I think from a public, and I'm sure my friends in the European, especially the reinsurers, will not like when I say this, but I actually think that one of the things that may lead us to get the backstop through a very hard to work with US Congress is if the insurers start losing some of these private cases. I think that's going to provide a motivation for them to to play ball in a way that the European insurers seem to already be doing, in a way that I think is quite helpful. So that's my talk. I thank you very much for listening, and I look forward to remarks and answering questions afterwards. And I managed to stop the share.
Okay, well, Helmut, do you want me to introduce James Davey next? Okay, then I'll do that. Welcome, everybody. I have the honor to introduce James Davey, who's going to talk about the impact of the FCA test case in the UK and beyond. Now, the problem, ladies and gentlemen, is that James and I haven't met yet. So what I have to do, I'll have to give you the information I've found on James' website, and I hope it's accurate. So James is a professor of insurance and commercial law within Southampton Law School at, no surprise there, at the University of Southampton. He joined Southampton Law School in 2014, and his research and teaching interests lie in insurance and commercial law general. James currently is Deputy President of the British Insurance Law Association, and he has established himself as one of the United Kingdom's leading insurance academics. So, James, we are proud to have you with us tonight, and the floor is all yours.
Thank you very much. I'm just going to check that my slides are visible and moving. Great, thank you. Okay, so thank you very much for the invitation. I'm really honoured at this inaugural talk, particularly to be sharing the stage, at least virtually, with Tom and so many other fabulous insurance academics. So my role here is to really give the picture in the United Kingdom, and in many ways, what we see is a picture that's almost the opposite of what Tom has described, this incredibly diverse, wide-ranging litigation in many different jurisdictions and different legal issues. So what I'm going to start with is the FCA data. So this came out on Monday of this week, so it's fairly up to date. And what I've done is to taken the top 10 insurers as listed by the FCA by kind of claims accepted, to give some sort of picture of where we are. So we have kind of claims accepted across insurers in the thousands for many of these. And we see that some of those have been are still kind of unsettled, so they're still working their way through negotiation, but a significant number have been settled in full. So the headline figures, you'd be looking at about 20,000 kind of accepted and dealt with, and about 20,000 still working the way through the system in total. But perhaps the big numbers at the bottom are what would really catch our attention. We're looking at about sort of £470 million in terms of money that's gone out. 280 million in final settlement. Those are dealt with, those claims, and 190 odd million in those where an interim payment has been made, but the final figure is still being determined. So this follows the FCA test case, which came out in January of this year. And so I think an enormous amount of work has been done by insurers subsequent to that case, and that really represented, I think, a quite significant trigger in moving from these cases being seen as disputed to settlement. Undoubtedly, there will still be, I think, further issues before the courts, but what I'll do is to look through the kind of substantive issues and look to see what the English courts have resolved and perhaps what left to be settled. So when we look at our litigation pattern, we have three cases. So two which arose as routine litigation, and I'll talk about those as I go through. But these are standard, an insured suing an underwriter on the basis of the contract. But the FCA test case is not, I think, on any basis routine. So it's the first ever usage of a particular form of civil procedure. So it's a pilot scheme now made permanent under the financial markets test case scheme. So what is a financial list scheme and a case, and how would it get through this this pilot? Well, you'd be looking at cases above about £50 million to be on the financial list to start with. Those could be contract related or chancery property related areas, but you'd be looking for something with a particular kind of financial services angle to them. To then get into the test case, having got onto the financial list, what you have to do is to persuade a judge that it's appropriate, and that requires showing the court that there is an issue that needs to be determined urgently as a matter of kind of broader public interest. And if you can persuade the judge that this is an appropriate case, you will then be able to litigate without a cause of action between the parties. So here, the Financial Conduct Authority as regulator has no standing. These are contractual disputes between insureds and underwriters. And so normally there'd be no basis for them to bring an issue to court. They're not enforcing kind of regulatory standards so that they would be a party to the litigation. You know, it's nothing to do with them primarily. These are contractual disputes. But this test case scheme enables the parties to litigate even if there isn't a cause of action between them, and to determine a set of facts. So a hypothetical set of facts can be put before the court. So here we have real policies which are being selected as representative across the UK market, and real insurers will then be defending on the basis of that. But the facts are hypotheticals. So we will assume that we'll have some holiday cottages, we'll assume some restaurants, we'll assume some hotels, and we will set up a set of facts in which we describe for the court what it will assume will have happened. So you don't have to have any of the normal difficulty of proving what occurred. You can simply negotiate that between here, the FCA as regulator, and the insurers. It's also the case that there's normally an agreement that would be expected that both sides will carry their own costs. Now, normally in the UK, loser pays, both sides. But here, both sides will know in advance that they're paying their own costs, win or lose. And the FCA were able to attract a really excellent, high quality set of litigators to represent them. And the 8 insurers that were concerned also got excellent litigators. These were all, high quality insurance counsel. And we begin on the basis of those hypotheticals. Now, I should say, for basis of full disclosure, I was a consultant to one of the insurers during the litigation, but obviously I'm talking here entirely in my academic capacity. So what this enables us to do is to take all of the live issues that we think are sufficiently significant, and the regulator is then able to act as a sponge to draw in information and concerns from policyholders and to put them to their legal teams and say, well, have we got arguments on this? Are we sure we've got arguments on that? And to deal with it. What was interesting, because of COVID, this all took place live streamed and on the web, and the FCA ran a kind of website which was updated on a daily basis. So you could see all of the claims, you could see all of the facts, the policies, the legal arguments made by counsel, which would normally not be publicly available. And all of this was available to the public, and you could sit in and watch the claims management conferences where they're arguing, well, who's going to talk first and how many days are we going to spend on each issue? So it was a really transparent process. I think there would be little concern with the team of litigators that were there of capture, that these would be litigators that wouldn't represent the insureds. But also some insureds did join. So there was the Hiscox group, action group, which was unable to join the litigation to represent its group of policyholders. So the process enabled us to channel the crucial issues. So I think now I'll move on to this kind of substantive issues. What is it that we did? And here really the UK looks very different to the US. So Tom spoke there in some detail about COVID as property damage, and as I'll show, that's not really engaged the British courts very much at all. For us, it's been much more the second area. So those additional add-on covers which had been sold within the market for things like notifiable diseases or denial of access because of public authority action. But it wasn't the core business that was really being tested, you have business interruption cover following property damage. And that was dealt with fairly quickly. So here we have FCA, that's the regulator, Dear CEO letter. So this is a kind of open letter to the industry as a whole, sent out something like 11 months or so ago. So we've spoken to the industry. We've decided that property damage isn't covered, but the presence of COVID within your businesses does not constitute property damage under English law. Now, in the paper that I'll provide later, I'll talk a little bit more detail about why, but I think this does reflect in many ways our own approach to property damage in tort. So what constitutes pure economic loss, what constitutes property damage, and our insurance policies have tended to reflect that line. And here I think the FCA is relying on that kind of vision. So when do I cause you economic harm? When do I cause you physical harm, as drawn from tort, and then crossed over into insurance contract interpretation? So I'll deal with that in the paper, not today. But if we look at those issues being tested, I've got one case, the TKC case, where the insured said, no, I think I can show property damage and therefore a business interruption claim. This was a restaurant which had frozen stock, and over the course of the lockdown, this will be a business in the UK that will have been open at times and then closed and then opened with the government blessing, go and eat and give everyone around you coronavirus to make sure our restaurants stay solvent, and then closed again and so on. They said, well, look, our problem has been frozen stock. So we have, frozen foodstuffs, and they're now out of date. We can't use them anymore. And that is, we say, a form of property damage. And therefore, because we have property damage, we think we can make a property damage business interruption claim. There was also a second argument run, which I saw reflected in Tom's slides as well, that denial of access, not being able to use the business, also constituted some form of loss of property. In that respect, some form of harm. And the court was not satisfied by this. And there were a number of problems that this insured faced. First, there was, for any property damage business interruption cover, a requirement that the property be insured. So in order to have business interruption cover, you had to have primary cover on the property, and the stock was not insured as property for property damage. So it would have failed to meet, criteria number one, and that's game over. Even if it had got over that, there were also within the business interruption cover extensive exclusions for inherent vice, latent defect, deterioration, and the like. So there were a whole series of specific exclusions that would say your food slowly going bad in your freezers is not an insured peril. So this was not, I think, a particularly strong case. It was dismissed summarily, so no full trial, not a sufficient prospect to continue. But the court did explain in a fairly lengthy judgment its reasonings. So made clear, first of all, that transient, so temporary denial of use of a property does not constitute property damage. And there are cases in which long extended denial of use, so someone steals my property and I know where it is, but I can't get it back. Or the kind of capture and seizure cases we see in marine insurance, where after a long period of time, you might say, well, I've been denied my property because I can't access it. But the court said that that's not met here, even if that could have that meaning in some circumstances, not in the case where you're simply prevented from using your business under government action for the periods of time we're talking about. And the reason for that is that if you made prevention of access to your business property damage, you wouldn't need business interruption business interruption cover for that. If you would already be insured for that kind of issue simply under your normal property damage in commercial insurance policy. So it would render much of our markets and business interruption insurance unnecessary. There's also, I think, a serious causal problem in the narrative tale. Because my business was closed, my stock went bad. The court said, well, the damage to the stock didn't cause your business to close. It's the other way around. The story is back to front. And so you can't say, I have just happened to have suffered some property damage at some stage, now pay me my business interruption. You have to show that the property damage caused the interruption and not vice versa. So not a strong case. And dismissed at that stage. But I think comparable to much of what are now still seen as live issues in the US. I'm going to move beyond that, though, really to the focus, which is our discussion of coverage beyond property damage. And so the British trade body for insurers, so the ABI, had produced in the kind of 1980s some kind of sample clauses for notifiable diseases, vermin, defective sanitary arrangements, murder, suicide, and the like. And this tends to be attractive as an additional optional cover for those in hospitality. Okay, so you're running a restaurant, there's a disease in the area, it doesn't cause property damage, but you'd have to close anyway. Or there is a notorious murder or suicide or something in the area, could affect your business even though no property damage. So you would pay extra and you would buy this additional cover. And these are the areas that were focused on in the test case. So to what extent did disease cover under this? Was that engaged? And denial of access by public authority action. Okay, so I'm going to start with disease. So if I'm kind of moving from property damage to kind of non-property damage cover, what about disease cases? Some attempt to test this outside the test case. So very recently, a Rockcliffe case, where rather than having a kind of broad definition of disease, there was a list. So it said, one is kind of food poisoning, and then two, as we have here, is cholera, even, plague, relapsing fever, smallpox, typhus. And then there's a third list, which is all sorts of another weird list of some bacterial, some viral infections. COVID isn't on that list, but also no other coronavirus was on that list. So SARS, nothing kind of equivalent was on the list. The insured here sought to argue that if you asked a reasonable policyholder, they would say, oh, it's a modern plague. And so that should be read, therefore, as falling under the definition of plague here. And the court said, no. In this list, plague means, this particular kind of bacterial infection, and it doesn't mean a kind of loose, common layperson language. It means a specific medical condition. And so there was no liability for COVID-19 under that. Much more commonly, and say this is the mass of cover that's really been tested in the test case, is where you're insured for a notifiable disease. So this is the dynamic list. This is a list of things that the state says you have to tell your local authority if there is an occurrence within your local area. So it's a kind of public health list of things that need to be notified. And COVID was clearly pretty early on one of those diseases. And the standard clause, this is the one treated as the lead clause litigated in the test case. So you have occurrence of a notifiable disease within a 25-mile radius of the premises, and it's the consequential effect on your business. So that's the kind of trigger that there is that occurrence. And then if that causes you to lose business, then you're insured. The real difficulty is how that applies when we're talking about not just an occurrence within 25 miles, but also an occurrence everywhere, not just within the 25 miles. And how do we indemnify in those circumstances? So here's the insurer's argument. The insurer's duty is to indemnify to the position as if the defined peril hadn't occurred. So if I remove from you all of the losses that flow from a local outbreak of COVID and put you in that position, insurers say, I pay you no money because it was also happening everywhere else. Even if you'd have been in the lucky 25-mile radius that had no occurrences, the government still closed down the country, still closed down hotels, still closed down restaurants, and you'd have been shut anyway. So I don't have to indemnify you. I have no duty to pay you because even though there has been an occurrence of the insured peril, it has caused no loss over and above uninsured events, the occurrence of the disease outside the 25-mile radius. And this, I think, was the central issue, really, that initially the High Court and then the Supreme Court had to face. And really, it had two mechanisms for dealing with this. The first is an interpretive one. So let's read the contract in such a way that we think we can solve this problem. And the second is a more principled, a causative basis. Let's think about how the rules of causation work, rather than tweaking the words of the policy to avoid the causation problem. First instance court tended to take the interpretive model, and the Supreme Court took a causal approach. So we're faced, as I said, with a problem that the businesses would have been closed even if there had been no occurrence within the 25-mile radius. And the court started to think about the but-for test, which I think is familiar to kind of most of us as a kind of fundamental way of thinking about responsibility in much of private law. And so the court said, look, thinking about what the causal test must mean in this particular context, we must change the principle to fit the needs of the market, to fit what must have been the expectations of the parties. So rather than starting with an immutable principle, it said that this rule, like I think almost all private law rules, are a matter of context. The but-for test would normally be used, but not here. So we don't consider it reasonable to attribute to the parties an intention that in such circumstances, the question whether business interruption losses were caused by cases of a notifiable disease within the radius is to be asking whether or not the same losses would have occurred because of the diseases occurring outside. That's not what the insurer promised. So this is what Professor James Stapleton has described as kind of oversubscribed causal occurrences. So more than one thing would have generated the loss, and we can't just apply but-for in a simplistic method here because we would find out that nothing caused the loss, that we would end up with a kind of null result. And so the new causal model that applies here is not quite as wide as we might think, but it's still fairly wide. Where we have wide effect damage from a single fortuity, so we have a single event, and that causes both local insured effects and distributed wider uninsured effects, the underwriter is not allowed to take into account the wider effects when looking to identify whether or not an insured peril has occurred, and if so, how it should indemnify. unless the insurer puts in explicit wording to that effect, like saying, we only insure you for the consequences of the local occurrence. And this matters for us beyond pandemic. And I know, having looked at the US case law, it also matters to many US lawyers as well, where we have things like floods, where we have hurricanes, where we have these wide effect harms. And so it's an attempt to deal, I think, generically with that issue. And I think the causal rule is modified there, but not, I think, for other forms of causal question. I think this is really a way of responding to those wide effect harms. Now, we had a case based on the occurrences, the Hurricanes Rita and Katrina, so the Orient Express case, which had suggested the opposite. But it was not a particularly strong authority, a high court decision, but based on an appeal from an arbitration. And that's been overturned. So that earlier view that we had has been overturned. So we would now ignore the effects of the hurricane or the pandemic more widely when looking to decide the extent to which the insurer must indemnify on local effects. Okay, conscious of time, I'll work through the second issue a little bit more quickly. This is the denial of access. What happens if my restaurant was closed or at least partially closed? These tended to be rather more straightforward interpretive questions. What does the contract mean? So it mattered, but less, I think, principled discussions. So the court said, and I think this must be right, that it didn't require restrictions, did not require the full force of law. So if the Prime Minister stands up and says, I'd like you all please to go home and not open your restaurants tomorrow, we will bring in legislation to make that binding in 2 days' time. The instruction from the Prime Minister counts as a state restriction, even before the full legislative process takes place in those sorts of circumstances. And I think that must be right. It also said that where insurers were indemnifying for loss of access to a business, you didn't need to lose complete access. So if you couldn't open your cafe, but you could run a takeaway service so that you could now deliver food, but you couldn't have customers into your service, and so your income dropped by 75%, the insurer could not say, but you can still keep your business open. It would indemnify for the partial closure of your business rather than the complete one. And again, I think that pragmatically must be right. Okay. Remaining thoughts. What strikes me really with much of this is this looks like an underwriting error. My image of kind of property insurance, out of business insurance and so on, to me looks like one of these Matryoshka dolls. Okay, so what we have is big wide cover at the outside, and then the conception from insurers is they do add on and add on and add on, and that they're necessarily smaller, right? Because they're fitting inside the wider cover. But when they wrote disease occurrence, they didn't seem to realize how quickly this could be correlated in a way that property damage tends not to be. It's actually very unlikely that we'll see, half of the United Kingdom in flames with a single property event that damages it, maybe with a flood, but even then it's not that distributed. But a pandemic, this is exactly what happens. And so I think the failure to appreciate how these little small add-ons that are meant to be the little last piece in the middle could rapidly blow the entire policy because they were bigger. The inside was bigger than the outside because of the risk of correlation. And insurers might say, oh, well, it's been 50 odd years since a pandemic like this. No. We had foot and mouth disease in the United Kingdom, which doesn't affect people, but affects cattle, less than 2 decades ago. And it absolutely ran through our agricultural businesses, including restaurants and others that were closed. So I think there was a short-term memory that should have been listened to here, and for some reason it got missed. Okay. Look forward to your questions. Thank you.
Well, thank you very much, both. And Eric, would you now introduce the 2 interventionists, or whatever you call them in English, please?
Absolutely. I think that's a great idea. Thanks, Helmut. First, I'll introduce Christoph Brommemeyer, who's the chair for civil law, insurance law, and European economic law at the European University Viadrine of Frankfurt. He's also the executive director of the Frankfurt Institute for the Law of the European Union and a member of the expert council of the Consumer Council, of the German Federal Financial Supervisory Authority. He's a founding member of this organization, the European Law Institute Special Interest Group on Insurance Law. So one of the originals, Christoph. He holds a PhD and habilitation from Humboldt University in Berlin and has researched and taught at a number of universities around the world, including Aberystwyth in Wales, Athens, Paris, and other places. So Christoph, welcome.
Well, thank you very much, Eric, for the introduction. So, business interruption insurance in Germany does not cover losses suffered by businesses because of forced closures under the German Infection Protection Act. The reason is simple. The policies provide cover only in case of physical damage of property, not in case of economic loss due to a pandemic. So Tom, the threshold question, the answer in Germany is clear. There is no coverage. So this is a brief intervention. This should be it. Okay, there is no coverage. However, many businesses in Germany have sought to recover losses based on additional business closure insurance policies. Now, these policies usually stipulate that the insurer shall pay compensation if the competent authority closes the insured company based on the Infection Protection Act in the event of the occurrence of notifiable diseases. Now, I don't have the time to talk about these policies in more detail, but I think it is safe to say that the policies differ, that the standard form policy language is often ambiguous, sometimes even unclear or incomprehensible, and that it is often unclear whether the insurer is liable or not. Now, in this situation, COVID-19 arrives on the scene. Insurance coverage in business closure insurance policies is uncertain. The Freistaat Bayern, which is Bavaria, stepped in. Take a look at the press release of the Bavarian Ministry of Economic Affairs. A business closure insurance, a Bavarian solution for hotels and restaurants. It's April 3rd, 2020, so it's almost a year ago. Munich. Good news for restaurants and hotels in Bavaria that have business closure insurance, whose applicability in the context of the corona pandemic is controversial. The Bavarian Ministry of Economic Affairs has now worked out a solution together with industry associations and insurance companies. The joint recommendation calls for insurers to assume between 10 and 15% of the daily rates agreed in each case of business closures and pay them to the restaurants and hotels. The following organizations and insurance companies have so far signed this recommendation. The Bavarian state, of course, DEHOGA Bavaria, which is an interest group representing hotels, bars, and so on, and Allianz, which most of you will recognize as one of the more prominent European insurance companies. Other companies have already signaled their support. There is a quote by the Bavarian Minister of Economic Affairs, Hubert Aiwanger, who said, from the point of view of all those involved, today's result is a viable and sensible solution for both sectors. The signal is clear. Bavaria will not abandon the owners of restaurants and hotels in the crisis. Now, Afterwards, the insurance companies, in response to notices of loss, wrote to their respective customers proposing the Bavarian solution. Take a look. Dear customer, thank you for your damage report. In your report, you inform us that your business had to be closed to prevent the further spread of COVID-19. The losses which affect society as a whole are not insured under the business closure insurance. We are aware that in such a situation, you need all the financial support you can get. Although we cannot offer insurance cover, we have found a joint solution with the help of government agencies, the Freistaat Bayern, of course. Our offer to you is to pay 10% of the daily compensation, max 30 days. We hope and wish that you'll be able to master the difficult situation with this help package, your insurance company. So here's the catch. To accept this offer, the customer had to sign a settlement clause. With the payment, all claims arising from this business closure insurance in connection with COVID-19 are settled. Now, the question is whether this proposal is a generous offer. You have no coverage at all, but we want to save society as a whole. That's why we are giving away money. Or whether this is a shrewd move to avoid liability. Many hotels and restaurants have signed the settlement agreement, believing that Bavaria had orchestrated this solution in their best interest. However, 6 months later, the Munich District Court handed down its first ruling on business closure insurance, assuming full coverage for COVID-19 after all. Now, many hotels and restaurants fear that signing the settlement agreement may not have been such a good idea after all. In the end, the Federal Court of Justice will have to decide. In many cases, the payment offers are what they claim to be. I personally believe that in most cases, they are what they claim to be, a generous offer. But in other cases, the Bavarian solution may turn out to be a rather questionable move to talk customers out of asserting their claims with the help of Bavaria. Now, this raises the question whether Bavaria should not have stayed out of it. I tend to believe that arranging settlements in the private sector is not necessarily a government function, but that is, of course, subject to discussion. Thank you very much so far.
Thank you very much, Christoph. And now I'd like to introduce Dr. Ulrike Monik, who's one of the principal lawyers at MBH Law Firm in Zurich, Switzerland. Dr. Monik specializes in insurance, reinsurance, and liability law. She advises national and international insurers and reinsurers and is frequently appearing in high-level insurance arbitrations. She's head of the section for Liechtenstein, the Swiss Society of Liability and Insurance Law, and holds an LLM and PhD. Thanks for joining us. She's going to be talking to us about COVID-19 cover in Switzerland.
Thank you very much, Eric, for this very kind introduction. I'm still trying to share my screen. Yes, I think it now works. So finally, after all these brilliant talks from quite famous people we've heard so far, we nearly come to the end. And so I really appreciate that you give me another 5 minutes to give you a rough overview over the situation in Switzerland. As all the other speakers, I'm talking exclusively about business shutdown losses, also known as business closure losses or business interruption losses. I'm using all these terms because in Switzerland, obviously, we use none of them. We use the German equivalent, and it is always a little bit difficult to translate it exactly into English. This is why I offer you all these terms. But what I really want to make clear is that I'm not dealing with any other types of insurance, which also may be affected by COVID. So what is uncontested in Switzerland? Other than in the UK and in the US, it is not even discussed in Switzerland whether plain property business interruption insurances would pay COVID-19 claims. This is accepted by all market participants that this is not the case. It is clearly understood that business shutdown losses are covered for any disease, by the way, only if the policyholder has bought a special business shutdown cover. Such business shutdown cover is normally a voluntary component of a property business policy that can be added to the basic property cover against an additional premium. And in Switzerland, this business shutdown insurance is also known as epidemic insurance. And usually it is taken out by restaurants, hotels, and well, enterprises dealing with food. But as in all of the other jurisdictions, what is contested in Switzerland is the question whether these business shutdown losses for COVID-19 are covered under our epidemic insurance. The initial position of the majority of the Swiss insurers was that there is no cover at all because of the simple fact that COVID-19 is a pandemic and that the epidemic insurance covers epidemics but not pandemics. Therefore, it was really held in industry that without any further need of an exclusion clause, such losses wouldn't be covered under epidemic insurance. Other insurers relied on exclusion clauses, and very few insurers settled the losses. Direction of the policyholders whose claims were denied, they were obviously not so happy, but most of them didn't go to court, but they filed complaints with the Swiss insurance ombudsman. And the ombudsman himself, in the beginning, was rather cautious. He didn't give any clear guidance in the beginning. Instead, he instructed an external expert to provide an opinion as guidance for the insurance industry. And this expert was Professor Fellman from CERN. And he, a little bit surprisingly for the insurance industry, took the side of the policyholders. And Professor Fellman held, firstly, that the pandemic is not an allude to an epidemic, but it is rather a particularly large epidemic. Thus, he held, cover cannot be denied by this sophisticated game of words. And in addition, what was perhaps more surprising, he also held that exclusion clauses wouldn't really help the insurers to avoid their liability. Not much to my surprise, he held that the influenza inclusion, which is part of most of the epidemic insurance policies, would not apply because COVID-19 or the coronavirus is not a flu. It was more surprising that Mr. Fellman also had concerns with the following clause. And it says cover is excluded in case that the losses are caused by influenza viruses and due to pathogens for which the WHO pandemic phases 4 or 6 apply nationally or internationally. So most insurers who had this clause in their policy conditions were quite confident that it would help because they had pandemics excluded, they thought. But Mr. Fellman took another view. He was very clear by saying that this clause is nonsensical in every respect. Firstly, he held that any categorization of pandemics by the VWH has no direct legal effect for Switzerland. And then secondly, he argued that it is completely irrational to talk any phase of a pandemic which would apply nationally in Switzerland. Therefore, he came to the result that this clause is not understandable and therefore void. What happened then? As I said, the result of the Fellman opinion was quite surprising to the insurance industry, in particular with regard to the pandemic phases 5 or 6 exclusion. Having said that, I would have to point out that the Fellman opinion is not binding neither on the insurers nor on any Swiss court. Nevertheless, most insurers thought about their initial denial decision again after having read the Fellman opinion. And I think the majority of the insurers who initially denied cover have in the meantime settled amicably with their policy holders. I'm not exactly informed about the percentage of these settlements, but I have heard that it is much higher than the German compromise or the Bavarian compromise. And I think it is a lot of insurers settled on a 50-50 basis for legal uncertainty. But all of these settlements contained a provision by which the policyholder have to agree that for the future, any cover for business closure is excluded. And now I think we come to the difference in Switzerland to other countries. Only very few policyholders went to court here. And to my knowledge, there has not yet been one court decision which has been finalized, not even in the first instance yet. In the end of the day, my statement is that whatever comes out in this court decision of the primary court, I think that the final decision on the question whether or not these kind of losses are covered under Swiss epidemic insurance are likely to be made by the federal court in a couple of years. So this was my intervention from Switzerland. And if you are interested, I have added for you in my annex some sample clauses which are used or which are quite common on the Swiss market, and also how Mr. Fellman dealt with these clauses. Yeah, that's what was it for my part. Thank you very much.
Well, thank you very much. And I think we have heard a very, very instructive overview on 4 legal systems dealing with COVID-19 insurance issues, mainly in the business interruption area. I think we have seen differences. I also think we have seen that it's quite helpful to have a transnational discussion of these things, because it's quite helpful to listen what American courts say in these cases, even from a Swiss perspective. It's very inspiring. Now, we have had also a quite vivid discussion going on in the chat room, and I've seen, Tom, that you have answered already several of the questions. I have also seen that Rob Merkin has intervened and answered some, also from a view of UK law. That's great. And I just wanted to ask our main speakers of today, Tom and James, whether you wanted just to add something as to this chat discussion for the overall auditorium. Tom, maybe you first.
So I really have there's a really great question in the Q&A, which is asking, why are the U.S. policies different than the U.K. policies? And I have to confess that I don't know. I mean, I imagine that the policyholder lawyers in the U.S. would like to say that they're different because physical loss or damage is so much broader in the U.S. that you don't need all these ancillary coverages. But I suspect that's not actually the explanation. And so I don't know. And I would, if there's any insurance underwriters in the audience, I encourage you to put a note in the chat, letting us know what your understanding of that difference is. And if James, of course, if you know, that would be great to know. And finally, I would just say that this has been really a wonderful opportunity to hear in a very efficient way what's going on in multiple places. And I just hope that once the pandemic is under control, and by the way, I have some sympathy with the notion that an pandemic is just a big epidemic. But once this is over, that I hope that we can continue some of these virtual meetings, because it certainly lowers the transaction costs and makes dealing with each other really great and helpful. So I hope we keep doing that.
Thank you, Tom. We certainly will. We're happy to. I see that there's also questions in the Q&A part. I see that Yong-Han has posed a question to you, Tom, specifically. It says, early last year, some US law firms have predicted that the doctrine of reasonable expectations might be useful in COVID-19 BI claims. In your tracked cases, were there any insurance claims on the ground inter alia of reasonable expectations? Would you be willing to answer that as well?
Yeah, sure. So first of all, I would like people to know that Yan Hong is the world's leading insurance law librarian. She's responsible for the insurance law collection at the University of Connecticut, which is a truly excellent collection. So I'm pleased to get a question from her. Courts do refer to reasonable expectations. Actually, courts that come out in both ways. The US flirted with the idea of a strong reasonable expectations doctrine, pursuant to which the courts could ignore insurance policy language. That flirtation is over. And so nowadays, the reasonable expectations doctrine is a way of resolving ambiguity. And so courts that have denied the coverage and courts that have granted the coverage have both, made judgments about reasonable expectations, which perhaps tells us that that's not a very good or necessarily helpful doctrine. Like if you're going to do a public opinion survey or something, but the courts may not be the elite judges may not be the best judges of what an ordinary consumer's reasonable expectations are, frankly, one way or the other.
If I can just add on that, on the interpretation side, the Supreme Court made quite a lot of the nature of the insureds for these products, that they were largely small and medium-sized enterprises. And so when interpreting it, said it's not the approach that an insurance counsel would take from reading through, 80 pages of cover and putting together a kind of neat spider diagram. It was the impression that would have been created in and there they have this kind of ambitious standard of the insured who carefully and conscientiously reads through the document, but's not an insurance expert. And that is, of course, even well beyond what most people will do. Right. But it was still very much targeted at the kind of business person to whom the product was sold, rather than an insurance expert. And on a number of occasions, there was an exclusion, 35 pages after primary cover. So they'd offer disease cover, and then 35 pages later, it says in an entirely different clause, not pandemic, not epidemic. And the court said, you didn't clearly tie these things together. And so no reasonable insured would have understood that is limiting the disease cover that you're buying elsewhere. So not a reasonable expectations doctrine, but equally not a kind of literal enforcement of the contract as written, something a little bit more between the two.
I will say that is not our impression of English courts. I think I'm going to revise my my understanding of how English courts operate. That's very helpful.
Well, thank you very much then. I think time is running and we are heading towards the end. So probably I should mention that in the chat you find also the mention of a decision of the Austrian Supreme Court. It's cited there, so you can actually look it up in the internet. I couldn't phrase it better than it is phrased in the chat. That is what I call a successful start for this series. Many thanks, and so on and so on. This is a great feedback from your side, and I think it's well deserved by the speakers and interventionists we had today. I want to thank you all so very much. This is now the end of what I would call exciting 90 minutes of transatlantic discussions on insurance law. My thanks, of course, goes to our speakers. That was a tremendous overview on all the situation and the comparison of it. And you made those 90 minutes an intellectual challenge. We are extremely grateful for that. I thank all the participants wholeheartedly. You can believe me that setting up this lecture series was hard work. It was many hours, but your participation and your interest in that shows that it was not just worth the effort, it was much, much more. And we are happy to proceed this way. And I combine this with a humble request, which is stay with us for the second lecture on reinsurance and COVID-19 on 27th of May 2021. And of course, beyond that event. Finally, one information. You may be interested to receive the slides of our speakers, and with their permission, we will upload them to the website of the Insurance Law Special Interest Group at the European Law Institute. If you Google the European Law Institute, you will find there a special section for special interest groups. Then you find our special interest group, and you will find the slides there. We will also send out an email and the link to those slides in the aftermath of this event. It may take a little time because what I usually call is that the European Law Institute is not what I would call overstaffed. So they have loads of work to do, and not just for our insurance special interest group. So it may take a couple of days, but then the slides will be uploaded and we'll inform you about this fact, and you can get them through this website. That's it. I wish you all a healthy and hopefully happy Easter. Keep the spirit. That's the most important thing in those days. And we all hope to see you soon again. On behalf of my co-chairs, bye-bye. Thank you very much.